Today for our presentation, we will be discussing IAS 37, that is Provision, Contingent Liabilities, and Contingent Assets. And this is the name of our group members. For our agenda, we will be talking about objective, recognition, measurement, reimbursement, and application of regularization and disclosure. And at the end, we will be doing a little activity. For objective, we will be discussing how appropriate recognition criteria, measurement bases are applied to the provision, contingent liabilities, contingent assets, and that sufficient information is disclosed in the notes to enable the user to understand their nature, timing, and the amount. The scope, we will be discussing that IAS 37 is not applied to any financial instrument because they're part of IFRS 9, and it does not apply to the executory contracts, but it applies to the provisions for restructuring, including discontinued operation. Before we go ahead, there are certain definitions that we need to get clear on. The first is the provision. It's a liability of uncertain timing or amount. Liability. Present obligation of entity arising from the past events, the settlement for which is expected to result in an outflow from entity of resources embodying economic benefits. Obligating event is an event that creates a legal or constructive obligation that results in an entity having no realistic alternative to settling that obligation. Legal obligation is an obligation derived from legal legislation or other operation of law. Constructive obligation is an obligation derived from a company's actions whereby past practice, public policies, or sufficiently specified certain statement the entity has indicated to other parties that it will accept certain responsibilities. Contingent liability is a possible obligation that arises from past events whose existence will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events that is not in control of the entity. Present obligation that arise from the past event that is not recognized because it's not probable that outflow of resources are required or the amount of which is not sufficiently measured yet. Contingent asset is a possible asset that arises from past events or whose existence will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events that is not wholly within the control of the entity. Onerous contract in which unavoidable contract of a meeting that obligation under the contract exceeds the economic benefits expected to be received under it. Restructuring is a programming that is planned and controlled by management and materially changes either the scope of the business undertaken by the entity or the manner in which the business was conducted. How provision is different from other liabilities, like trade payables. Trade payables are the liability to pay for the goods or services that has been received and supplied but and has been invoiced or formally agreed by supplier, while accruals are the liabilities to pay for those goods and services that has been received or supplied but has not been paid, invoiced, or formally agreed by a supplier, including amounts to employee. How a provision is different from contingent liability. All provisions could be contingent, but all contingent liabilities could not be provisions. Provisions are recognized as liability. They are present obligation and are probable. Contingent liabilities are possible obligation. They are present obligation, but they are not probable, or maybe their amount is not reliably measured yet. For today's presentation, we will be talking about two major companies, that is TELUS and CIBC, to get hold of this IAS 37 today. I will be passing over to my partner, my group member, Sanjay, to go over it. Thank you.
Thank you, Ishmeen, for starting us off. Now I'm going to cover the recognition part of IS 37. So, as we know, provision is a liability of uncertain timing or amount. So, for us to recognize a provision, there has to be three conditions, which all of them have to be met. First one being there has to be a present obligation as a result of a past event. The second one being there should be a probable chance of outflow of resources, and the last one being a reliable estimate can be made of the amount of the obligation. So I'm going to talk about these bolded terms for us to understand them better. Can you have the next slide, please? So how do we identify the present obligation? So there has to we have to gather all the evidence we can, and based off such evidence, if there is more than 50% chance of the present obligation being there at the year end, we have to recognize the provision. However, if the chance is less than 50%, we have to recognize a contingent liability instead. Can we have the next slide, please? how is the past event obligating? So a past event that leads to a present obligation, that is called an obligating event. So there can be two reasons for that past event to be obligating. First one, it can be a legal reason. So let's say there is a legal requirement by government to remove a specific asset from a natural resource, or the second one can be a constructive obligation. So that can be due to a company's policy. So let's say the company has some refund policies, so the company should adhere to that if a customer wants a refund. Next slide, please. So as it is the same with the as the obligation. What are the economic benefits that the outflow we're talking about? So will the company will have to pay? So here we have to again gather all the evidence we can, and after gathering all that evidence, if there's more than 50% chance that the company would have to pay to settle off this obligation, we have to recognize a provision if the all the other conditions are being met or not. And here we also have a reliable estimate of the obligation. So based on the information we have, we should try to get a best estimate, try to measure the amount of the liability we have. If in rare cases we cannot recognize a provision on the financial statements, then we'd have to disclose them as a contingent liability instead. Can we have the next slide? So contingent liabilities, as Ishmeen walked us through them. So a contingent liability is not recorded on the financial statements. These are disclosed instead, unless the possibility of the outflow of resources is very remote for the entity. And these are assessed like regularly so that the company has enough information, and when this contingent liability becomes probable, so there's more than 50% chance of this obligation and outflow of resources, we just turn it into a provision. So let's say a company had a legal case going on against them, and if the lawyer stated that there was more than 50% chance of the company losing the case, then it would be a provision. However, if the lawyer said that the chance of losing was less than 50%, or we couldn't come up with a reliable estimate of what company would have to pay if they lose, we should report a contingent liability on the notes of the financial statements. Can we have the next slide? Contingent assets. So a contingent asset is not recognized in the financial statement, but it is disclosed where the inflow of economic resources is probable. So even if there's more than 50% chance of us getting some resource or economic inflow, we would not report it as an revenue or an asset on the statements unless it is virtually certain. So again, as contingent liabilities, these are measured continuously, and if the chance of us to get inflow of resources through this contingent asset becomes virtually certain, so when the company is very sure that they will get those economic inflow, we record the contingent asset as a revenue. Can we have the next slide? So here I just have an example of TELUS and their financial statements where they have recorded some short-term liabilities, and in those they have provisions which basically included some employee-related provisions they had. And on the next slide, I have CIBC's disclosures where they have disclosed some of the legal cases they have going on against them, but they don't know the outcome yet. So they don't record the provision, but just disclose it. Now, Jasprit will walk us through the measurement part of the standard. Can you unmute, Jasprit?
Okay, sorry. Hello, everyone. So we have discussed about the provisions, contingent liabilities, and contingent assets on how to recognize those. So for now, we will discuss how to measure those provisions, contingent liabilities, and contingent assets. So we use the best estimate method to measure those provisions because this help us to estimate the expenditures that is required to use those to report for the reporting period and to help us report the obligations. And we will look into the examples in the coming slide to discuss about the best estimate. For best estimate to find, there would be different cases. So there could be a single provision or there could be multiple provisions. For example, if there is a single provision, in that case, the amount the entity will have to pay or have an obligation, it should be reported at the end of the reporting period. Okay, let's look at the example for the single provision. So in this case, the company has acquired an asset in 2020 and has a useful life of 5 years. And because of the change of the environmental laws, so the company have to pay additional cost. And for that we can see that there is a provision because there is obligation that the company have to settle in the future, and then like we can measure that provision because there is a cost there. So we can see that the provision is there, and then we can estimate the cost, and if the company can dispose that asset internally, then the cost will be 50,000, and if they need external contractor, then the cost will be 60,000. On that base, we can also make a journal entry by debiting legal expense of 50,000 or 60,000 based on the company favors, and then also credit asset retirement obligation for the same amount. Okay, let's look at the next example. So if we talk about the uncertainties, so uncertainties arise due to change, or there is need to predict the value of the cost. So for that, if there is a multiple provision, so we use the expected value method. And for that, let's look at the example here. So if there are multiple provisions, for example, in this case, so there are provision that the company have there could be major defects or there could be minor defects, and there will be cost associated to that. So for that case, we can use estimated weighted measurement method to come up with the estimated value. And with the help of that, so the cost will be 11,250, and we can make a journal entry for that amount. Okay, so let's look at the present value. So usually, so present value method says that when the company need have a present obligation, future obligation, and instead of using the future cost, the whole amount, the company can use the present value, like by discounting the future value to present value, and then can use a discount rate. And also we need to make sure that the discount rate that we are using is pre-tax, because we just want to make sure that the amounts, the estimates that we are using are accurate, and we are not using double taxation on that. And then if we talk about the expected disposal of asset, so any gains that are recognized are not measured as a provision, because there is a separate IAS and IFRS for measuring and recording assets, non-current assets held for sale, and then the property, plants, equipment. So instead, so we should not measure or recognize any provisions for any gains on disposal of assets. Okay, so here is an example from TELUS. So this is the disclosure provided by TELUS in their quarterly reports for 2024, where they had mentioned that for the provisions for asset retirement obligation, they had used the present value method to record the provision, and also they are revising and then also making estimates to the provisions yearly and making adjustments to that, and considering if there are changes or effect of inflation or discount rates or future cash flows on their statements. Thank you.
Reimbursement can only be recognized as an asset when it's almost certain that the sales party will make a payment. This means that there must be strong evidence to indicate that if the entity repays the debt, it will receive the reimbursement. Reimbursement is considered separately assets rather than a reduction in provisions. The confirmed amount cannot over the amount of relevant provisions. For example, a company need a provision for a long-short settlement for of 500,000. If the company has an insurance that is expect to reimburse 400,000, it can recognize a separate reimbursement asset of 400,000. Reimbursement in the financial statement. In the statement of comprehensive income, the expense related to provision may be a percent of the reimbursement amount. In the balance sheets, the provision is recorded as a liability, and the reimbursement is recorded as a separate asset. So, for example, Taylor is facing a lawsuit and expect to pay 100,000 in a legal settlement. The company has an insurance coverage, and the insurance coverage will reimburse 70,000. It don't need to show the 100,000 expense and 70,000 reimbursement separately. So we only allow to report the net expense of 30,000. Change in provisions. Review and adjustment of provision. At the end of each report period, an estimate must review provision and adjust them to reflect the current best estimate. If new information suggested that the original estimate was too high or too low, the provision must be adjusted. If it is no longer probable that the estimate will have make a payment, then the provision shall be reversed. So, for example, a company originally estimate a $2 million lawsuit provisions, but later determined the case was unlikely to result in a payment. So, the provision is reversed. Use of provision. A company must only use a provision for the specific expense it was originally created for. If the provision was recognized for a lawsuit, the company cannot use the same provision to cover the inventory write-off or employee severance payment. This ensures transparency in financial reporting and prevent companies from misusing provision to manipulate earnings.
So I'll be covering the application of the recognition and measurement rule. As per IAS 37.63, provision shall not be recognized for future operating losses. For example, if Dallas is expecting a decline in sales of 2% next year due to decrease in demand for one of their products, this decline in sales Dallas cannot recognize provision, as these will be operating losses and do not meet the general criteria of IAS 37.14. On the same note, if an asset is not generating revenue for company, that asset should not be that asset should be tested for impairment of asset under the IAS 36. Next up is onerous contract. As per IAS 37.66, if an entity has a contract that is onerous, the present obligation under the contract shall be recognized and measured as a provision. So let's first understand what is onerous contract. As per IAS 37.68, the onerous contract in which the unavoidable cost of meeting the obligation under the contract exceed the economic benefit expected to be received under it. So if the economic future benefits are less than the unavoidable cost, then it will be onerous contract. Now let's see what are the unavoidable costs. So one of them is contract fulfilling cost. If any entities want to continue with the onerous contract, then the cost will be the whole cost of fulfilling the contract, less the expected revenue from the contract. Second one is cost of exiting the contract. If an entity want to exit the contract, there will be some termination fees and penalties that will apply. And as per IAS 37, provisions should only be recognized lower of these two costs if the cost of exiting the contract is lower than the cost of fulfilling the contract, then the provision should be created for cost of exiting the contract. Costs that can be included are the following as per IAS 37. Direct costs such as direct labor, direct material cost that occur to fulfill the contract. Allocated costs such as depreciation on the asset used in fulfilling the contract. And in the case of asset impairment due to onerous contract, entry should recognize an impairment loss as per criteria of IAS 36 before recognizing the provision. Next up is restructuring. IAS 37 allows recognizing a provision in case of possible restructuring event in the organization. Restructuring may include events such as sales or termination of a line of business, the closure or relocation of business location, change in management structure, fundamental reorganization that have a material effect on the nature and focus of the entity's operation. As per IAS 37.72, a constructive obligation to restructure arises only when an entity has a detailed formal plan for restructuring that should include the part of business, affected location, number of employees to be terminated, expected expenditure, and timeline of plan. Secondly, entity should raise a valid expectation in those who are affected, such as employees, customers, and suppliers, by announcing the main features of the plan. A restructuring provision does not include following costs: marketing cost, staff training cost at new location, investment in a new system, such as computer or printers at new location. This is a financial statement notes for provisions of Thales of 2023 annual report. The main focus part is the other provisions. In the other provisions, Thales included legal claims, non-employee related restructuring activities, and contract termination cost and onerous contract related to business acquisition.
Hi everyone. I'll now talk about disclosures. The purpose of disclosures is to ensure that the users of the financial statements are aware of the true financial condition of the entity. Disclosures are made for provisions, contingent liabilities, as well as assets. And as per IAS 37, entities are required to disclose each class for provisions, contingent liabilities, and contingent assets. Classes means different groups. I mean, like warranties, asset retirement obligations. They are different classes. For provisions, entities are required to disclose each class of provision, including carrying amount at the beginning and the ending period, additional provisions, any amounts used or any unused amounts reversed. And then provisions are both recognized in the financial statements as well as disclosed in the notes. Here's an example which shows the beginning balance of provisions, and then there were some additions in the year, and then the ending balance of $1,200. This is a sample of Thales consolidated financial statements notes. We can see here asset retirement obligations, employee validate options, written put up options. They are all classes, and it clearly shows here what the beginning balance was. And we had some additions in the period and some reversals, and then we get to the ending period. So they recorded all the additions, reversals, and all this stuff. Here's another example for CIBC, which shows a beginning balance and then additions in new provisions and then ending balance. And then for entities are required to disclose brief nature of the obligation. It means like what kind of obligation is it? Is it a lawsuit or any other obligation? And then any indication of uncertainties about the timing or amount of force. Like what would be the financial impact of outflow? And then the amount of any reimbursement. And then for disclosure for contingent liabilities are not recognized, but they are disclosed in the notes. And Entities are required to disclose each class of contingent liabilities as well, with brief description of the nature of the liability. Here's an example of contingent liability. Is CIBC Bank's example. Uh, uh, they had one case against Fresco in Ontario, and then one against Godet, that's a Quebec. They filed lawsuit against them. And then this is contingent disclosure for contingent asset, where inflow of economic benefits is probable in the future, and entities are required to disclose that in the notes of financial statement. Contingent assets are not recognized, but they are disclosed in the notes. Here's a brief summary. So provisions a liability of uncertain timing or amount. It is both recorded and disclosed. Contingent liability is not recorded, but it's disclosed in the notes. And same goes for the contingent asset. It's not recorded, but goes in the notes. Thank you.